Welcome to Personal Finance for Long-Term Investors, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Hello and welcome to Personal Finance for Long-Term Investors, episode 128. I'm Jesse Kramer. By day, I work at a fiduciary wealth management firm helping clients nationwide. You can learn more at bestinterest.blog/work. The link is in the show notes. And by night, I write the Best Interest blog. I host this podcast. I also put out a weekly email newsletter, all of which are free and all of which help busy professionals and retirees avoid mistakes and grow their wealth by simplifying their investing, their taxes, and their retirement planning. And we've got a fun episode today. I've compiled a list over time of some so-called dumb moves in financial planning, at least, suboptimal moves in financial planning, but moves that personally I'm okay with, or I have some rationale behind them where I kind of see this thing and I say to myself, well, it's not nearly as bad as people say. And, some of the stuff might make Dave Ramsey cringe. Some of the stuff won't be what a spreadsheet says is ideal. Heck, maybe some of this will make you unsubscribe from the podcast and unsubscribe from the newsletter and leave a nasty comment on the blog. Well, I really hope not. But at the very least, I think it'll make you think. Before we get into the juicy fun stuff, we'll do a quick review of the week. This one is from cprime25, who left a 5-star review and said, "Great personal finance show. Great informative show that covers all aspects of personal finance." Thank you, C Prime, for that succinct and to-the-point review. I'd be happy to send you a Supersoft podcast t-shirt. Drop me an email to jesse@bestinterest.blog, and I will get you hooked up with that Supersoft t-shirt. And now, without further ado, let's dive into the fun stuff, the controversial, the dumb, the suboptimal takes that I actually think are okay. The first one is having some small sandbox investing account, a side account of fun money, a cowboy account to take your personal bets. Going back to some of my original investing lessons from John Bogle himself, I've never seen an issue with someone taking 5% or 10% of their money. I will say I draw the line personally at 5%, hopefully not much more than, say, 10%. But taking that small portion of their money, but still, a pretty reasonable slice of the pie, setting that money to the side in some way, and then taking any number of potential investing bets under the sun with that money that they've set aside. I think one exception here that I'll point out before I go any further is taking on leverage or taking on short positions. If you can lose more than the 5% or 10% that you're putting at risk, you're probably doing this wrong. But anyway, the point is that if you really need to scratch that particular investing itch because, your brother-in-law gives you interesting stock tips, well, I get it. You can go follow your brother-in-law's advice, but do it with 5% of your money. Then take the other 95% of your investable assets and follow the tried and true long-term investing principles with that money. If 95% of your money is doing the smart thing, the efficient thing, I'm pretty confident you will get to where you want to go over the long run. On paper, well, this is bad advice because let's be honest, most of us will do worse with the 5% play money than we will with the 95% smart money. Most of us will be hurting our overall returns, will be hurting our overall performance versus if we'd simply left the money alone, if we'd kept all 100% working in this smart, efficient way. If we're all a little more robotic, the numbers would probably look better on paper. But as you will hear time and time again today, we're not robotic, we're humans. And if being that little investing cowboy on the side is enough to scratch your itch, I say giddy up. Personally, I've shared here on the podcast before that outside of my very typical long-term investing account, I own these tiny slivers of, say, Berkshire Hathaway, an individual stock, right? Warren Buffett's company. I also own this tiny sliver of an ETF that holds Bitcoin and an ETF that holds Ethereum, another cryptocurrency. I'm scratching the itch a little bit there. I'm also, in case of cryptocurrency, buying a little bit of schmuck insurance so I don't feel too stupid in the long run if they perform well. In sum, though, those 3 positions, the 2 cryptocurrency and the Berkshire Hathaway positions, they make up barely more than 1% of my investable assets and less than 1% of our family overall net worth. The crypto especially, I believe, has a real chance of losing significant value or going to zero, and I'm okay with that risk. The other 99% of my investable assets are all rowing in the right direction. I think you could make a legit argument that owning Berkshire is basically like owning a large mutual fund, and actually one that has many, many structural benefits to it. So the Berkshire ownership is probably rowing in the same direction anyway, too. If you have an interesting cowboy account story, though, I'd love to hear it. But for now, we'll move on to the next topic today, which is deciding to prioritize paying off a low-interest loan typically in concert with some of your other goals, but still, the idea that you're going to prioritize paying off a low interest rate loan. A spreadsheet would tell you that paying off a low interest loan is dumb and inefficient. After all, why would you pay off that 5% mortgage when you can make 10% in the market? Or so the argument goes. Well, I really don't like that particular argument, so I think this topic deserves a little bit of nuance. If we're going to make the what return could you get in the market argument, we need to be honest. It's a guaranteed loan, right? A guaranteed rate of return or a guaranteed interest rate on the loan versus an unknown return from the market. And I think that distinction really matters. Would you rather have a guaranteed 7% or an unknown risky return? Sure, that risky return, if we're talking about the US stock market, has historically averaged out to 10% per year over the last 100 years. I get that in the math. I won't argue with it. But there's no guarantee it'll do so going forward, especially over any short or kind of midterm period of time. Of course, that argument has some gray area too. What if it's a guaranteed 4% from paying off the loan versus an unknown risky maybe 10%? Well, that feels different than a guaranteed 7%, right? Paying off a 7% mortgage should feel different than paying off a 4% mortgage, and there's some gray area, there's some nuance here. For what it's worth, I personally feel very much different about paying off a 7% loan than I do paying off a 4% loan. If your mortgage rate is lower than cash interest rates, okay, I really do think we've now kind of ventured away from the gray area into a black and white area. So to be specific with some numbers, if you happen to be one of those lucky people out there who secured a 2.5% mortgage, and right now as I record this, cash is earning 3.5%, I really can't defend any sort of early loan payoff in your particular case. But let's look at a current day example, right? Right now, most high yield bank accounts are paying between 3.25 and 3.5%. That's a guaranteed interest rate on short-term reserves right now. And let's say you have a 4.5% mortgage. And meanwhile, just about every other asset class under the sun is up more than 4.5% over these past 12 months. So are you a dummy for choosing to pay off your mortgage right now when it's only a 4.5% interest rate? So one way I like to answer this question, I'm not sure it's the perfect way to answer this question, but I would honestly ask you, how much sleep are you losing over your mortgage? Or another good question, how worried about you entering retirement in debt with that mortgage still on your balance sheet? In other words, how much better will you feel by taking more action against your mortgage? Here's another good question. How much worse would you feel if the stock market drops 20% in the next 12 months? And if your stock investments drop 20%, when you could have used those same exact dollars today to pay off your mortgage? Does that make sense as I've explained it? Every single day, we all are doing something like that. We are all, say, for example, choosing to keep tens of thousands, hundreds of thousands of dollars in bank accounts or in a taxable brokerage account. Perhaps that taxable brokerage account is invested in the stock market. We are actively choosing to invest in stocks over paying off our mortgage. In my personal case, I am choosing the unknown, volatile, risky 10%, I hope, from the stock market over the known 6.5% from paying off my mortgage. That's what my mortgage rate is, 6.5%. So what if over the next 12 months, those same stocks that I own today are down 20% and I haven't paid off my mortgage at all? Well, I'm going to want to jump into a time machine back to today, before the 20% drop off in the stocks, before the bear market, and I'm going to want to sell those stocks today and use that money to immediately pay down my mortgage and guarantee the 6.5% return. Right? So the question is, how much worse would you feel in that case? Except your time machine, like my time machine, right? It's not working well. And you're going to have to sit there 12 months from now. I'll be there sitting in hindsight bias because, of course, you believe you made a good decision at the time you originally made it. But you're going to have to sit there second guessing yourself. Will you be okay with that feeling? Not everybody is. Now, personally, I think I'm okay with that feeling, right? I understand the probabilities and the odds well enough to know that, yeah, sometimes you make this probabilistic bet in investing. The odds are in your favor, but the odds aren't 100%. And anytime, it's just like gambling. Sometimes you make this probabilistic bet that you know if you continue making that smart bet time over time over time, eventually, in the long run, it'll average out in your favor. But on any given flip of a new card from the top of the deck, you might lose. And this trade-off is kind of the same way. So the point is that I'm okay with someone choosing to pay off lower interest debt instead of taking on a higher return investment risk. It's okay to strike a balance instead of optimizing your spreadsheet in this case. Okay, the next one on the list is leasing a car. Now, I've gone back and forth on leasing a car. In fact, I wrote an article about a year ago, Confession, I Leased a Car. I'll link to that in the show notes. And when I wrote it, I will say a few other people, they reached out to me and they said, hey, Jesse, I think you're missing some points here. And I think they actually made good points. So here's my one point that I still stand on when it comes to leasing a car. I'll say, all else being equal, right? It's not really a smart financial move. It's hard to make a good argument for it. If nothing else, it's kind of just a luxury move, right? Most of the time, I'll say it that way. Most of the time, it's just a luxury move. It's a flex where you get to say, yeah, I'm going to intentionally spend 10 to 20% more on my all-in car costs just so I can drive something that I really want to drive for a short period of time, and then just change it up without any sort of hassle in 3 or 4 or 5 years, however long the lease is, 2 years, something like that. But there is one legitimate financial reason to lease a car, and it has to do with cash flow. It has to do with this fact that, if I buy a car new today, let's say I buy a $35,000 car, which unfortunately is kind of this roughly average car cost these days, and I get a 4 or 5% loan. I'm just kind of doing some math in my head here. So let's say it's a 4-year loan. I've got 48 months to pay off $35,000 plus some interest. It's probably going to be $800 a month, if not a little more, in terms of my monthly car cost. I'm buying the car, right? I'll own it at the end of those 48 months outright. But meanwhile, my cash flow for the next 4 years, I'm out $800+ a month. That same car, if I leased it, would probably be around $400 a month, or roughly half the cost. So if you're in a particular position where you say, at least over the short term, maybe because of some unknowns in my financial life, I'm not really in a position to commit $800 of monthly cash flow to a new car. I'd rather just commit $400 of that cash flow, and then in 3 or 4 years, have to make this decision starting from scratch. You're committing the $400 of cash flow. You're not really getting anything for that, right? You don't own the car at the end of the day. But at least when I look back at my decision to lease a car, I feel pretty good that that was the position I was in. And at least now, 12 months later, I feel pretty good that I still made the right decision, that I didn't want to commit that higher amount of cash flow to car costs at that time. And I thought that really I would kind of I was growing my cash flow enough that given 2 or 3 years of time, in my case, it's a 3-year lease, that I'll be able to make the decision fresh in 3 years. And then I'll probably buy the long-term family car that we need at that point. So anyway, even leasing a car, which I think, in terms of black and white and gray issues, it's pretty black and white. But there's just that little smidge of gray that I think is worth understanding. And a lot of issues in financial planning have that little smidge of gray. Here's a quick ad, and then we'll get back to the show. Every January, we make the same promises: eat better, work out, read more books, and of course, something about money. This year is the year I finally get my retirement plan organized. Personal financial planning is one of the most common resolutions out there. So if 2026 is a year you want real clarity, serious financial planning, a full review of your complex financial picture, or just someone to help you make good decisions with confidence, I'm currently accepting new clients. You can head to bestinterest.blog/work and fill out the short form. Let's make better finances the resolution that actually sticks this year. Going on to the next issue, holding some extra cash. How big should your emergency fund be? You'll get answers that vary far and wide, but usually it's measured in months. 3 months of spending, 6 months of spending, 12 months of spending, something like that. Some people say it's enough to cover your largest insurance deductibles. That's how much cash you should hold. Well, what about someone entering retirement? There's a much wider spectrum of cash allocation recommendations here, and the recommendations overlap with portfolio recommendations in a lot of ways. So for example, there's some reasonably well-known retirement portfolios that consist of a few years of cash, usually 3, 4, 5 years of cash, and then everything else in stocks. The idea is that the cash provides a serious buffer should any serious stock bear market occur. But what if you're listening right now and the idea of a 6-month emergency fund doesn't make you feel good? Or what if you want more than 5 years of cash to start your retirement? 5 years worth just doesn't feel like enough. Or perhaps more simply, what if you know you're already on a good path for a successful financial life, and now you're just asking yourself what to do with your kind of marginal additional dollars? Do you take risk with those additional dollars, or do you just build a larger, safe foundation? Point being, there are many different reasons to hold on to cash. Some of those reasons have the serious objective rationale to them. For example, the more I learn about sequence of returns risk, the more appealing it is to me to have at least 6 years of low volatility assets to start retirement. That might be cash, that might be US Treasury bonds with a proper duration to match up with those 6 years. But either way, I can see the reason for having more than 5 years worth of really safe, low volatility assets to start retirement. But then some of the cash reasons are very subjective. If you've already won the game and you have another year worth of cash burning a hole in your pocket, Does it make you feel better just to keep it as cash? I won't argue with that feeling, especially if you're in a position where you've already won the game. Now, the spreadsheet, of course, is never going to tell you to keep any extra cash on hand. Why? Because, well, we input those rates of returns into our spreadsheet. And if you input 3% for cash right now, and then you input 9% for stocks or 7% for a moderate portfolio, the spreadsheet is going to very, very clearly tell you exactly how much cash you need to have on hand. So this really is a subjective one. It's not black and white. There's a lot of gray here too. The next one, a very interesting topic that certainly came to the fore here in 2025, last year in 2025. And this topic is using a correction or using a bear market, maybe even using a crash to change your asset allocation. It's a really interesting one. There's a lot of nuance here, so let me see if I can explain it well. Let's say it's 2014. You realize you're behind on your retirement planning. You discover the online personal finance world, the FIRE movement, the Bogleheads, the idea of low-cost diversified passive investing, the whole 9 yards. And within a month, you've tightened the belt, you've opened up a couple new investment accounts, and you're dollar cost averaging into, say, VOO, the S&P 500 index fund. And then over the next 6 years, you watch your assets grow for the most part. 2018, maybe your investments dropped a little bit in the fourth quarter. Now, that's not ideal, you think, but that's the life of a stock investor, at least according to what you're reading online. That 9% drop that happened in the fourth quarter of 2018, well, that's normal, right? That stuff can happen. And anyway, by April of 2019, you're back to an all-time high. And by early 2020, your earliest investments from 2014, they've almost doubled in just 6 years. And since you've been dollar cost averaging, well, not every dollar of yours has doubled. Sure, your more recent contributions haven't grown that much yet. But still, you feel like you're in a great place and you're starting to feel more on track, right? You felt behind in your retirement planning in 2014, and now just 6 years later, you see the light and you know you're on track. But then in March 2020, you log in every single day to see your portfolio drop and drop and drop. In fact, on March 23rd, 2020, the low point of the COVID crash, you would have logged into your account to realize that every single dollar of gains from the past 6 years of investing was gone. Well, to be slightly more accurate, the total account returns summing up for 6 years of investing in one of the greatest bull markets ever, on that day in March 2020, the 6-year total return was below 1%. Not 1% per year, less than 1% total. I think it's hard for me to explain what that must have felt like here over a podcast, right? We only get to relive the past through some memory or by looking backward at charts. But the world was shutting down, right? Everyone was worried. Life as we knew it was taking a 90 turn, and your retirement dreams, which for 6 years had seemed so hopeful, all of a sudden you're literally back at square one. The money wasn't gone, but your returns were basically zero. It's like you'd been dollar cost averaging under your mattress the entire time. Like literally, it's the amount of money that you put in over 6 years was essentially the same as the amount of money you had on that day in March, just like you'd been hiding it under your mattress. So you might ask yourself, is this investing, right? You invest for years and years and years, and then poof, all of your returns disappear literally in 3 short weeks. So for many investors, COVID was the first big one that they suffered through. For other investors, the great financial crisis was the big one, or the dot-com bubble, or maybe even Black Monday. Shout out to any of you investing back in 1987. The point is that these kind of events can rattle the most stoic Boglehead type investors. It begs a really hard question. Am I really actually comfortable with 100% of my investable assets exposed to the stock market, or 90% or 80% or whatever your allocation is? So now going back to where I started this whole story about making changes to your portfolio in the middle of a bear market, or because of a bear market, or because of a crash. So what I don't think is appropriate is someone making this rash, complete overhaul of their portfolio, like literally in the middle of a crash or a bear market. I wrote about this topic extensively in April 2025 in the middle of the tariff tantrum. But what I do think is okay is to make some sort of slow, steady, tempered, low emotion plan to eventually shift your portfolio away from high risk exposure. It's not that you're selling out of fear during the worst of times, but it's that the worst of times, which again, don't happen that often, it's that the worst of times made you realize what your true willingness for risk is. You thought your willingness for risk was one thing, and then this really bad time in the market made you realize like, oh, my willingness for risk is actually much less than I once assumed. Everyone has that plan until they get punched in the face, as Mike Tyson says, right? These terrible times in the market, when they happen, they can punch us in the face. And suddenly we realize, I think I might want that mouth guard after all. Okay, the next topic is taking Social Security ASAP. Now, the more you dig into the details of a comprehensive financial plan, the more you realize a couple different important truths. The first one is that Social Security itself is an important pillar for most retirements even. So even those retirements for, say, high net worth retirees, people who from the outside you might think don't really need Social Security, it's still a very important pillar of their retirement plans. But then the second thing you realize is that the specific timing of Social Security claiming is this negotiation between math on a spreadsheet and the feelings of security, no pun intended, of the retiree. Meaning, Bob is going to retire this spring at age 64. Everything about Bob's financial plan points to him delaying his Social Security until at least his full retirement age of 67, if not the upper limit of 70. That's how his retirement plan has the greatest probability of success. But Bob just can't get over the idea of no longer having a paycheck. It's going to be a huge change for him. It's this mental hurdle that he just cannot step over. And no matter what the spreadsheets say, Bob decides to apply for Social Security right away as soon as he leaves his job so that he can maintain this kind of mental accounting of a paycheck coming in every month. And the question is, did Bob just totally ruin his retirement? The answer is probably not. Without diving into every single detail of Bob's story, most retirees can afford some wiggle room in their Social Security claiming timing. There are some cases where a retiree's plan might be right on the cusp of success, and in that case, any number of dozens of different risks could push them over into the risky, limited, threatened retirement. And sure, in those cases, Social Security timing is one of many factors that these retirees need to do their best to get right. They need to ignore their feelings and follow what the math suggests. But in most cases, if we talk in terms of, say, Monte Carlo analysis, solid retirement planning tool, if you know what you're doing, you might see a retiree with a so-called, 85% chance of success, which is good. And then if that same retiree decides to do something suboptimal with their Social Security, their chance of success will often drop, but by 1% or 2% or maybe 3%. Now, the details are certainly important here, but having done this a bunch, that's usually what you see. So if taking Social Security 3 years earlier than optimal means you get to sleep better at night for those 3 years, but it also means your chance of retirement success drops from 85% down to 83%, well, I'm going to be okay with that. Okay, on to the next one. The next one I have here is intentionally owning your company stock as a point of pride, as an incentive to work harder, as having skin in the game, putting your money where your mouth is, whatever it may be. This is very much related to the sandbox idea I talked about before. If you work for Microsoft and you want a little bit of extra Microsoft in your portfolio, again, as that point of pride, so you can eat your own cooking, so you can kind of put your money where your mouth is, I'm okay with that. Again, it's all about determining the right size of this extra bet in your own company stock. I will say there's an extra risk here because the place where you're getting your income from, right, all your future human capital is invested in that company. And now you're going to put some of your investment capital into that company too. So there's a little bit of extra risk, but I'd lean back to the sandbox rule and I draw the line at 5% of your portfolio. So when someone comes to me with 40% of their portfolio in their own company stock, I don't really like that. But if you have 95% of your money invested in a smart, logical, fundamental, long-term manner, and then 5% of your money in your own personal company, I'm fine with that trade-off. It's not that I believe your portfolio will be better off for it, because I don't. But instead, I think that you will be better off for it if you tell me that's what you want to do, and the portfolio damage that you might be doing along the way won't be that severe. The next one is choosing to put money into a taxable brokerage account before you max out your qualified retirement accounts. Over the long run, any qualified account where you get a big tax advantage up front or you get a big tax advantage upon distribution, and you also get tax-free growth along the way, any one of those qualified accounts is going to outperform a taxable brokerage account. The one exception, though, which I'll link to in the show notes, is when if your workplace retirement account, like a 401k, has such high fees that the fee drag is actually worse. Fee drag is actually worse than the maybe matching money that they give you. It can happen. It's pretty rare. As an example, if your 401k has an overall fee of 1% per year, which is pretty high for 401ks these days, and your 401k matching percentage is only 25%, then you'd likely be better off skipping the 401k in the first place and just putting your money in a taxable brokerage account. Anyway, that is the exception, not the rule, and I'm digressing a little bit because what I'm talking about here are people who have access to good 401k accounts. They have access to a Roth IRA, they have access maybe to an HSA account, and yes, they do use those accounts, but they also use a taxable brokerage account. And in some cases, they're choosing to contribute to that taxable brokerage account before maxing out all of their qualified accounts. They don't squeeze all the juice out of their qualified opportunities, and some people see that as a really big problem. But when done for the right reasons, I don't really see any problem at all. So what are those right reasons, you may ask? Well, taxable brokerage accounts provide time flexibility. There are no hard and fast rules about when you can withdraw that money, how much of that money you're allowed to withdraw in a month, in a year, or anything like that. Taxable brokerage accounts also provide withdrawal flexibility via the combination of withdrawing basis, which is not taxed at all. That's just the money you contributed in the first place. You can also withdraw capital gains, which are taxed at preferential to capital gains rates, more preferential than, say, income tax rates, which might affect IRAs or 401k accounts, those withdrawals. For many sound retirement plans, which again may last 20 or 30 or 40 years, those retirement plans may see drastic shifts in tax regime and tax landscape over time. The idea of having a three-legged tax stool for flexibility, that's simply a smart idea. And again, those three legs, you have some dollars in pre-tax traditional accounts. So those are accounts that will be taxed as income eventually upon withdrawal. You have some dollars in tax-free Roth accounts. They're never going to be taxed in any way ever again. And then you have some dollars in a taxable brokerage account. You can withdraw it at any time for any reason. The basis won't get taxed. The capital gains will get taxed at a capital gains tax rate. But all of a sudden you have this flexibility. You have these tools that you can kind of give and take and ebb and flow with. And depending on the given tax regime during that period of retirement, depending on your lifestyle needs during that period of retirement, you have these different levers to pull. In fact, there's some pretty smart people out there who talk about their regret for overfunding qualified accounts earlier in life. I know Nick Majuli has a story that he leans on a lot about maxing out his 401k throughout his 20s, only to realize in his 30s that his most pressing financial need was a down payment on a house. But all of his potential liquidity was locked up in his 401k. And sure, it's nice to have that money when you're retired in your 50s and 60s, but Nick needed more money right now, and his decisions in his 20s prevented that from happening. So I'm certainly not saying stop your 401k, stop your Roth contributions, put it all in taxable account. I think that's a bad idea. But I am saying feel free to make measured contributions across many different investment accounts with all different tax treatments, because it's unlikely you'll regret providing yourself with that flexibility when the future comes. Here's a quick ad, and then we'll get back to the show. I send a free weekly email to thousands of readers that shares two simple things, just two. The first are my new articles and podcasts, so you'll never miss when I publish new content. And the second is my favorite financial content from other corners of the internet, so you can see what's been helping me the most.
But Jesse, I don't want another email.
I hear you. I make this newsletter short, sweet, and full of essential information, and readers enjoy that. About 85% of newsletter subscribers are engaging with the newsletter more than once a month. They're enjoying it, and you will too. You can subscribe for free on the homepage at bestinterest.blog, and you'll get a free PDF of my white paper titled The Step-by-Step Guide to Building Your Retirement Paycheck. That's right, a free weekly email that thousands of people like you are already reading, a free white paper to help you plan for retirement, and you can sign up for free at bestinterest.blog. The next one here is using an HSA early to actually pay for run-of-the-mill medical expenses. Back in episode 124, I went pretty deep on HSA accounts, including the ideal way to contribute to them, to let them grow, and eventually the way to use them to reimburse old medical expenses. In short, the ideal method means that you do not pay for any medical bills early in your life with an HSA. Instead, you save all those receipts, you log all your medical expenses, say in a spreadsheet, you invest your HSA dollars, and you allow them to grow tax-free for years and years. And only later in life, after years of tax-free growth, do you then decide to reimburse your old medical expenses, and all those reimbursements and distributions, they're all tax-free. The money went in tax-free, it grew tax-free, it's distributed tax-free. So that triple tax advantage is pretty unique to HSA accounts. And that long-term reimbursement strategy I just outlined, it allows you to maximize that triple tax advantage to the utmost. And again, that's what a spreadsheet would tell you to do. But you know what? Sometimes you've got a busy household with 3 kids who are catching the flu and twisting their ankles, and then you have a weird rash that requires a series of dermatology appointments, and your spouse is having a hormonal imbalance that requires a visit to the endocrinologist, and the next thing you know, you've spent $7,000 on your deductibles this year, and you really didn't have $7,000 out of pocket lined up. Suddenly your emergency fund is a little slimmer than it's been in years, and it gets worse and worse and worse, whatever. But the point is that, to me, that seems like a perfect time to say, well, wait a second. We've got $40,000 saved up in our HSA from years and years of diligent saving, and spending $7,000 of that $40,000 would all make us feel a lot better right now. I know the spreadsheet tells you not to, But to me, that kind of use just feels like good common financial sense. And I'm a big proponent of using your HSA early to pay for run-of-the-mill medical expenses if it's going to make the rest of your current financial life that little bit easier and less stressful. The next controversial topic that I don't think is that big of a deal is renting even when you could afford to buy the house. Now, the rent versus buy debate is something that I believe will never ever die. And that's okay. As much as I love diving into numbers, that's not a debate I'm particularly interested in diving into. I think the problem is that every time I've ever seen it done, the numbers either feel obviously incomplete or so unbelievably nuanced that it's hard to understand and just hard to argue with. So anyway, not going to get into that. I do like some of the rules of thumb, this ratio of your home payment versus an equivalent rent divided by the interest rate, blah, blah, blah. Okay, cool stuff. And I think if I was either in the market for a house or an apartment, or if I was a residential landlord, I'd probably be much more interested in this topic. By the way, episode 101 of this podcast is a good one if you're asking yourself, should a retiree, should a long-term investor own residential real estate as an investment? But anyway, I just want to focus on this particular topic, rent versus buy, and whether one is better than the other, or, really whether one is financially better than the other. Can you save money by renting? Do you save money by buying? And I jokingly just lean on something that I call Jesse's theory of rent versus buy, equilibrium, and efficiency. I know that's a mouthful. We're just going to focus on the words equilibrium and efficiency right there. In economics, this equilibrium point is this nice resting place in a market, a resting place between price and quantity, a resting place between buyers and sellers. Everything is nicely in sync. Supply tells us how much producers want to sell at a given price. Demand tells us how much consumers want to buy at a given price. And if you plot those two lines of supply and demand, you will find a point where they intersect. That's the equilibrium point. And at that point, at that price, the quantity supplied equals the quantity demanded. There's no natural pressure for the price to move up or down, and the market has essentially a clear view on that product. So that's equilibrium. Now, the second term I mentioned before, efficiency. You might be familiar with that term efficient markets from the stock market, as in the efficient market hypothesis. An efficient market is one where the prices do a really good job of telling the truth, and I use that word a little bit cautiously. It's not that the market is guaranteed to be right. It's not that the market is predicting the future with certainty. It's basically that it's the best estimate we have given the information available right now. The market has efficiently processed all the information to give us the best estimate for value we have given that information. In an efficient market, prices quickly reflect any new information that's provided. In an efficient market, thousands or even millions of buyers and sellers are all competing for the specific product or good in question. If something is obviously mispriced, smart people will rush in to profit from that mispricing, but in doing so, their demand will move the price in the opposite direction and will actually eliminate the mispricing. Just in case that doesn't quite make sense. If there was this one gas station in town, maybe they just put up the wrong number. They're selling gas for $1 a gallon and everything else is at $3 a gallon. Well, everyone's going to go to the gas station that's selling at $1 a gallon. And pretty soon they're going to realize, something is going on here. Why is there all this demand for our gas? Oh, well, we actually just made a mistake, right? It was 1. We ought to mark it up now to 3. But even if it was just, say, a little bit cheaper, at any time a product is mispriced in that way, the people who are flocking, who are sending their demand toward that product, are going to naturally push the price up. That's what demand does. You can kind of see that these ideas of efficient markets and economic equilibrium points are somewhat related. Now, let's go back and think about housing markets and renting markets. We can think about them nationally if we want, or we can think about them in your little corner of the world. Are there thousands, if not millions, of people who live in homes, who buy or sell homes, who rent apartments, or choose to rent out their space to another tenant? Yes. There are millions of people who do that. And if the underlying financial data was so overwhelmingly clear that buying was better than renting, or that renting was better than buying, what would these thousands or millions of people do? Well, they would flock to the better choice. And in doing so, their demand for that better choice, or their lack of demand for the worst choice, would do what? Well, it would drive the price of the better choice up, and it would drive the price of the worst choice down, such that the overwhelmingly clear better option would actually kind of muddy up. It would become gray, not so overwhelmingly clear anymore. So again, efficient markets naturally eliminate any mispricing. So I would argue that on any given day, week, month, or year, I'm sure there are local markets in America where renting seems clearly better than buying and vice versa. And that might be true. but I do not think it is likely to be some sort of permanent rule of economics. I don't think it can be. If it was that way, if it was so overwhelmingly obvious at all times, efficient consumers would eliminate that mispricing. Therefore, my conclusion via, kind of amateur economic theory alone, not even diving into the numbers, is that renting and buying must be similar enough so as to not be worth losing that much sleep over. That's my theory. And my last topic today has to do with what I call true lazy investing. And I'm going to bury the lead a little bit. I won't tell you exactly what I think about true lazy investing quite yet. But what do I mean by true lazy investing? I think that lazy investing in its laziest form involves the following. Your investments are all index funds. It involves a very small minimum number of different funds. I think 3 is probably the maximum, but lazy investing can totally be done with just one fund. It involves the same asset allocation in every single account, or put another way, really no concern about asset location. No such thing as putting tax inefficient bonds inside of a qualified account. No such thing as putting tax efficient stocks in a taxable account. All of your accounts just have the same exact asset allocation. Certainly no tilts, no small cap tilt, no value tilt, no momentum, certainly nothing more exotic, no single stocks, no individual bonds, no alts, no real estate, no gold. You rebalance probably once a year around the same time you take your one set of withdrawals, again, once a year, assuming you're in retirement. That's what I think of as lazy investing. Maybe there are a couple attributes of lazy investing I'm leaving out, but pretty much that's it. Super simple, hands off, everything just looks the same. You're not really touching it. You go in once a year, you rebalance, you pull some money out. That's it. If you want to invest this way, I believe 2 things. First, I think you're leaving a little bit of money on the table. I think there's some more juice that you could squeeze out of this approach, really without that much extra effort. But, and this is probably the more important part, but I also recognize how great this approach actually is, how close this approach is to what I might call the final product. And I don't want to make perfect the enemy of good enough. That lazy approach, believe it or not, is good enough. I was thinking of some funny analogies here, and the one that comes to mind is from the world of golf. Not that I'm an expert golfer or anything, but I admire the skill that it takes. And there's a story from Tiger Woods' career. Maybe some of you are already familiar with it. You know where I'm going. Tiger Woods was the most dominant golfer the world of golf had ever seen. But in his pursuit for what he thought was perfection, Tiger worked with a couple different swing coaches in the late 2000s, which he's already like one of the best golfers of all time by the late 2000s. He's already the most dominant golfer of all time. Like he'd reached the top. And yet he went to work with a couple different swing coaches to make his swing even better, even more consistent, even more perfect. But to all outside observers, whether Tiger's swing actually looked more aesthetically pleasing or not, the shots he was hitting certainly were not better. Virtually everyone agrees that his heavy tinkering with expert coaches made his swing worse, made him a worse golfer. And if we go back to the world of investing and we think about this spectrum, and on one end of the spectrum, we have a portfolio that's so simple it's actually bad. And then on the other end, we have a portfolio that's so complex that it's bad. Way more investors live on the complex side of that spectrum. And it's way easier to find yourself moving toward so complex it's bad than it is to find yourself moving towards so simple it's bad. If you're 59 years old, you're retiring next year, and 100% of your money is invested in the S&P 500, that's very simple. I also believe that's not the right portfolio for 99% of 59-year-olds who are retiring next year. So yes, I do think it's possible to be so simple it's bad. But let's say that same 59-year-old came to me and said, Jesse, I sold 25% of my index fund and I decided to keep it all as cash, as a 5-year cash buffer. So now I have 5 years of cash plus the other 75% in the S&P 500. 75 stocks, 25% cash. Well, that's still a very, very simple portfolio. And if it were me, yeah, I'd make a couple important tweaks for sure. But I would bet that super simple 25% cash, 75% stock portfolio actually is going to work just fine for that retiree. It's not ideal. I don't think it's perfect, but it's just fine. And I only share that example to explain how simple you can get without getting yourself into any sort of real trouble. Whereas on the complex side of things, it feels like there are infinite ways to build bad, complex portfolios. And I know that because when I'm reviewing someone else's portfolio, and if I see significant problems with it, 98% of the time, if not more, the problems I'm seeing are due to complexity badness, not due to simplicity badness. So back to my point, while the laziest of lazy investing isn't perfect, it's also certainly not bad enough to tear apart or to call for a red alert. So anyway, that's it for lazy investing. And I'm sure this podcast episode could go on and on. There's no shortage of, debatable, controversial, outright dumb moves in personal finance, and perhaps some moves that make the talking heads can argue with, or that spreadsheet warriors would debate about hundredths of a percentage point. But to me, I guess my overarching thought is some issues are black and white, but plenty of issues are gray. And I think one skill that's hard to develop and probably impossible to perfect is determining what's different between these true black issues, the true white issues, the really, really dark gray issues, so that it's basically black, but maybe not quite there, versus the actual kind of middle of the road gray issues. And then what are the underlying factors that make these issues that way? To me, the only thing that I found helpful in this cause is intentional and continuous learning. Now, some of you receive my weekly newsletter, and you'll see that I send out, my new article and my new episode. But I also send out my favorite 3 things that I've read or watched or listened to that week from the online financial planning world. And I'm not joking around there. I'm consuming a lot of really interesting ideas from the world of financial planning and investment management. Over time, those ideas slowly start to shade these various subtopics, a little bit more black here, a little bit more white here, or definitely gray over there. And so I really do think if you want to start to maybe develop some of your own black, white, and gray radar, an investment in knowledge pays the best interest. Thank you for listening.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.